accounted for as equity shares and has issued the following financial instruments. Class B shares contain a call option. So this means that we would have the choice, the ability to call them back again. So that puts the power in the hands of BRIC. So BRIC has a call option. The dividends are payable on B shares if they're payable on the A shares. So if we pay a dividend on the A share, we have to pay a dividend on the B share. In fact, we have to pay the same amount of dividend. Two questions. Do I have an obligation to pay the dividend? No. I don't have an obligation to pay the B dividend because I only have to pay a B dividend if I pay an A dividend, and I don't have to pay an A dividend. So there is no obligation to pay the dividend. If there was an obligation to pay the dividend, I would have a liability. Yeah. Do I have an obligation to redeem the share? No. No. I have a choice. Yeah, it's a call option. That's my choice. So I'm under no obligation to give them their money back. I'm under no obligation to pay them a dividend. Therefore, this is equity. Yeah. So I can easily see 2-3 marks for that. Mark for the conclusion, a couple of marks for the justification. There is no obligation to redeem. It's a call option. There is no obligation to redeem. It's a call option. There is no obligation to pay dividends because you don't have to pay an A dividend. Yeah? Class D. How long am I going to live for? How long am I going to live for? I don't know. Will I live forever? No. No. My father is still alive. He's 86, so that's a good thing. Because one of the best correlations about how long you're going to live is how long you're... My mother's still alive as well. So these are good things for your genes, for your prospects of living long. I had a grandmother who died at 99.
Wow.
Yeah, and another grandmother who died at 89. My grandfathers died early. They were both injured in wars, terrible things. Wars. One injured in the First World War, well, both injured in the First World War actually. One was a pilot, one was gassed. I never met him. But anyway. How long will the directors be a director for?
As long as they're alive, or as long as they're in the office.
What's the answer to D? Debt or equity?
Equity is
I'm going to die. Hopefully not in a war. Hopefully in my bed, painlessly in the sleep when I'm an old man. But I will die. So if I'm a director of a company, I will not be a director of the company forever and ever and ever. I may be a director of the company for 3 years, contract comes to an end, it's just 3 years. I may be a director of the company and resign, I may be a director of the company and be fired, I may be a director of the company and die, but I will not be a director of the company forever. So if we have issued shares to a director, although there may be no contractual obligation to pay a dividend, the shares will be redeemed by the company when the directors vacate office. They will redeem the share. The company is under an obligation to redeem the share, therefore these are debt. Yeah? The directors will one day vacate office. There is an obligation to redeem when they do. So the directors will one day vacate office. And therefore this creates debt, this creates an obligation. Thirdly, Brick has a contract, in return has received $10 million. This gives the counterparty the right to buy a fixed number of Class A shares for a fixed amount. The contract is to be settled by the issuance of shares. So what we've got here is a contract for the issue, which will be settled for the issue of shares. It is for a fixed amount, it is for a fixed amount, and therefore this is going to be equity. It is fixed and fixed. Yeah, a fixed number of shares, a fixed number of shares, and a fixed amount of dollars. And therefore, on that basis of it being fixed and fixed, it is equity. So we have, I think, almost exhausted, this business of is it debt and is it equity. But you understand the importance of that classification, because from a user's perspective, gearing is a very key ratio. Are you asked to calculate ratios in P2? No. No, it's not an interpretation. That's what you do at F7. But you do need to be aware that users will place an importance on the significance of risk. Yeah? And they measure risk through debt. Oh, is that a bit quick? One more time. Fixed. Fixed and fixed is equity. Number of shares, amount of dollars. Now, I've been standing here, sitting here, I have been talking to you about the classification of a financial instrument, and we have been saying it's either borrowings or it's debt. And I think some of you know about a compound instrument. I think some of you know about a hybrid instrument. I think some of you know that it is possible to issue a financial instrument and it's both. That the one contract can contain an element of debt and an element of equity, and therefore it becomes necessary for us to separate out the debt and the equity components. Do you know what I'm talking about?
No, sir. I don't know.
Some say they don't know, some are shy, and some are saying convertible loan notes. If you issue convertible loan notes, basically you borrow money. If you issue convertible loan notes, you are basically borrowing the money, but the word convertible. Because at the option of the subscriber, they have the option of converting the debt into equity. And that creates, therefore, an option embedded within the contract. So the gross proceeds have to be separated out and separated between debt and equity. So if you effectively receive 100 for your convertible loan note, you've got to say 90 is debt and 10 is equity. You've got to split it out because they are fundamentally different and will be accounted for in different ways. The debt element ends up amortized cost. The equity element being equity, of course, boring, nothing happens to it. How do we go about doing that split? We go about doing that split using the measurement of the debt. So you would look to measure the debt at fair value. You'd look to measure the debt at level 3. You'd look to measure the debt at the present value of the future cash flow. So I have a very brief note, or we can go straight into a question and use the question to explain what is going on. And so let's go back, let's have a look at Joshua. Let's go back and have a look at Joshua. And Joshua is on page 1-4, because we're going backwards now, not forwards. We're going backwards, not forwards. We're going backwards, not forwards. So we're on page 1-4 for Joshua. We're on page 147. Convertible debt is a compound instrument which contains both debt and equity elements. Which contains both debt and equity elements. Equity is the option to convert. The equity is the option to convert. We will apply split equity accounting. We will apply split equity accounting to the gross proceeds. We will measure the debt element as the present value of the future cash flow. We should measure the debt element as the present value of future cash. So page 147 is a convertible debt story. If we are to explain how we're going to account for this, it's a compound instrument which contains both debt and equity elements. The equity element is the option to convert. The equity element is the option to convert. And because you're giving them that equity element, you get away with giving them a lower coupon rate than you otherwise would have done. Convertible loans are characterized by a low coupon rate. So the equity element to convert. The split equity accounting to the gross proceeds, and we measure the debt element as the present value of the future cash flow. Having got the debt element, you run it at amortized cost. Having got the equity element, that nothing would happen to that. So the key numbers, so far as I am concerned, is in your profit and loss, you will have a finance cost, and in your statement of financial position, you will have an equity reserve, and you will have a non-current liability. So in terms of any number crunching, it's let's take it forward 12 months, and there are three key numbers that come out of a convertible loan note. The finance cost, the non-current liability, and the equity reserve, the other components of equity. This is a staple diet for F7. But some of you haven't done F7. What I think I will do is say nothing for 2 or 3 minutes, and it may be that some of you would be able to have a go. But have a read first. Have a look first. Have a look at Joshua. Yeah, we're on page 147, and we are thinking about how we should go about splitting the gross proceeds. Splitting the gross proceeds.